Hello everyone, hope you're doing well. Today I wanted to talk about a couple of stocks with an ex-dividend date coming up in the next week, and I think I might make this a weekly series where each week I find a few stocks that I think are at a good value now to buy with an ex-dividend date coming up in the next week. So there are two that I'd like to go over this week that I've looked through lots and lots, and these two stood out after I did a bit more research. So initially I was going through many of the stocks on my valuation spreadsheet here and just seeing if any stood out. Right now, Nvidia and Victory Capital are the two that really stand out. Victory Capital, you can't see the price to cash flow ratio here, but if I go, that's because there's not data for 2018 and 2017. So I'm going to go into the manual spreadsheet where I put in more information, which isn't just the automated values myself, to get a bit more of an accurate representation, because as you can see for Nvidia, it might have good percentages. This price to sales ratio is 200% and the revenue growth is 44%. That's obviously not sustainable, but as there was other good things in here as well and the PE looked sustainable, I thought I'll do a bit more research and I'll go into detail on those numbers in the manual spreadsheet. And this is where I change everything in these yellow highlighted boxes for the company to get a bit more of an accurate representation. So this is Nvidia. I've gone for 15.5 earnings growth rate. As you can see, the realistic growth rate based on calculations on their, well, I'll show the realistic growth rate picture on screen now. I'll just bring that up. So this here is how I calculated the realistic growth rate. You can see the formula here, and you can pause if you'd like to read this section. But using this formula, I got a value of 19.38% for the realistic growth rate, and the analyst 5-year estimate is 23.4. Now, I like to use half of the analyst growth rate estimate to be on the conservative side, and that's because analysts typically estimate 100% higher than what the actual revenue growth turns out, or not revenue, but what the actual earnings growth turns out to be. So what I've done for my calculation is just the two lowest, it's the average of the two lowest of the three here. So 15.54, that's the point in between these two. And if I show you Nvidia's earnings growth expected on here, as you can see, it's flying up to 7.4 per share in 2025, whereas we've only costed for 5.2 in 2025. So there's a lot more room for this to be even better. So I've gone for a 15.54% earnings growth. Now, it's a bit cheeky, Nvidia. They don't have much of a dividend. You're not going to get a massive dividend off of them, but you do get that little dividend, a little bit like Apple. You're not really getting it for the dividend, but it does bring you that, and it has great growth across expected estimates. So looking at this, it is one I'm definitely interested in picking up now. There is a tiny bit of share dilution I've accounted for. As you can see, it's gone from 2,532 to 2,516. So really, you probably don't need the share dilution here. I could set that to 0 and it would look even better. But I was just accounting for the cost of potential share dilution that could happen. But to be honest, you could definitely get rid of that because it doesn't look like there's much. Revenue growth rate, sitting at 18%, I have this. Again, similarly to estimates, you can see it's flying from 28.37 billion to 46 billion in 2025 on the estimates, which is what I've put it at. Personally, price to sales isn't as relevant for a stock like this. If I go over to the screen here, you can see price to sales is mainly a ratio which is used for during launch, before the company even breaks even. So it's not overly important, the price to sales ratio. The one you really want to focus on is price to earnings, but it's good to have that price to cash flow in there as well, because, and I'll show you an example of the reason it's good to have that price to cash flow, is because it can signify things which the price to earnings doesn't always signify. For instance, if I show you Netflix here, you can see their price to cash flow minus 102%, so their fair value is terrible for price to cash flow, and it just shows up red flags. As you can see, their cash flow only 300, but it was minus 2,000. It wasn't good at all. And even though their earnings at the time, their earnings they were reporting were great at the time, but when you can see that alongside a cash flow like this, it can bring attention to potential flaws in those earnings. So I like to have the cash flow price alongside, just for that extra safety of judgment. So going back to Nvidia, looking at the manual inputs I put in, here's the historic PEs. I've raised this to 47 from what was the average in here. Going back to the averages in here, you see it was at 44.89, but that's brought down quite a lot by this 35.48 in 2018 as one of my averages is of the lowest 4 values, but at 35.48 I felt like it was dragging it down quite a lot. The next highest being 40 and then 45. 45 is the third lowest over the last 6 years, so I felt 47, that's a safe value to go in at. Price to sales, I've gone for 14. That may be a little bit on the high side, but you can see this lower numbers were quite a few years ago, and it was up as high as 26. But I'd be happily enough bring that down. But as I say, this is all price to sales ratios. We're not overly fussed with that, as the main things we want to focus on are probably price to earnings, and then just look at that price to cash flow to see if that is matching and not showing any red flags with the price to earnings ratio. And then the price to cash flow ratio, I've gone for 50. You can see it has a massive spread from all the way from 23 to 127, so it's not always the clearest, but I think 50 is safe, and I think it could fall under that, potentially 45. As you can see on here, it was 43.95, but I've gone for 45. I'll put that in now, and you can see it aligns nicely. It's still showing that it's at a good value based on that ratio. Along with this, we can see that all of these ratios are looking good based on the estimates, and there isn't any significant red flags. So this is why Nvidia really stands out to me as a potential buy, because there's no real red flags among any of the ratios, which I think is really, really good to see. Alongside Nvidia, I also think that Victory Capital Holdings is good. I mentioned the price to sales ratio not being overly important at this stage of maturity, and I think that's clearer, or not clearer, but it's more important to emphasize here, because as you can see, the price to sales ratio fair value falls in at 20.12, and the price for Victory Holdings is 27.57, but it comes in on the PE, it's way over the fair value, and the price to cash flow is over as well. So I think as those two are over and this company is in maturity, I'm not overly fussed with the price to sales falling under, and it's not drastically under where it looks horrifying. It is obviously a massive amount, but I'll reiterate, the price to sales isn't going to make or break this. Now, for some reason, the price to sales imported the same as the price over earnings here, so we do have to go over here and look at it, but this is where I got my value from. If we look at the financials, you can see the statements. Price to sales ratio, you can see it's sitting around between 1.7 to that 3 value, so somewhere like 2.3 to 2.6 is probably a fair average. I put 2.4 in here, and based on the price to operating cash flow, we had to put this in ourselves anyway, as the references for 2018 and 2017 weren't available. So again, looking at this, I went for 6.4, and if you look at the price to cash flow here, you can see it's been above, this is the current at 5.29, but since 2018 it's always been above 6.78, so I think going in at 6.4, I think that's conservative enough to be okay. And the earnings growth rate, I put it in at 6, but we could shoot that much higher. As you can see, the realistic growth rate's 11 and the half analyst growth rate's 6, so we could even boost that up, but again, I like to be conservative so that there's extra room for error in my judgments. As you can see, even with this price to sales ratio fair value being nearly $7 under the market price, it's still, even though it's accounted for in the average fair value, because the price to earnings ratio is a similar amount more than the market price, this has still fallen under the average fair value. And with the price to sales ratio not being overly important for a company at this stage of its life cycle, I think this is fine, and we don't need to overly worry about this. Another thing I have done on here, I've reduced the share dilution to 0, because since 2018 it's only moved from 72 to 73, and it was 74 before, so I don't think 3% is fair, because this is based on the 59 in 2017, And so here, as it was already up to 72 and hasn't really moved since 2018, I've put the share dilution to 0% for this. But that is just a quick summary of the 2 stocks which I feel, as there's only 2 this week, that I feel are at a good value to buy now with ex-dividends next week. If there are any others that you'd like me to look at or potentially do a stock analysis on, let me know in the comments, and I'll go into that in a bit more detail for you. But I highly recommend these 2. But do your own research, put in your own manual inputs, and if you would like this sheet, I did a video on it a couple videos ago that you can check out, and if you want to find out a bit more information on how I've done this, and if you do really want to find out more about that, go visit that video. But until then, I hope you enjoyed these recommendations, and yeah, happy investing. Bye guys.